Hey everyone, the new tax law has officially been signed, and for retirees, this is a big deal, especially when it comes to how you plan your retirement for tax efficiency. And by the way, that needs to be one of the big considerations when you're thinking about how you're going to create retirement income. Now, there's a lot that we can talk about with this new legislation, but the most important thing to know right now is this. You have a 4-year window to take advantage of what I think is a powerful planning opportunity. All of these changes are not set in stone and made permanent where they're forever. Some parts of the law are going to be permanent, but others, like the senior bonus deduction and the expanded SALT deduction limits, are only available from 2025 through 2028. And that means the 4 years ahead of us may be the best chance to act. And in this video, I'm going to walk you through what the new law means for your retirement plan. So, what's changed? What's staying the same? And how to make the most of this planning window while it's still open. So, there's a lot packed into this new tax law, and we couldn't possibly cover everything in one video. We could spend time on the expanded child tax credit, the changes to charitable giving, the temporary deduction for auto loan interest, or even the expanded SALT deduction, which is going to be a big deal for some households, especially in certain states. But today, I want to narrow the focus and look at the provision that I think creates the most broad-based planning opportunity for retirees. And that's the increased standard deduction, including the new bonus deduction for those over 65. This is where retirees can take real meaningful action while the tax law is in effect and where its potential for long-term tax savings is the greatest. The biggest change in this law is that it makes the lower tax brackets and larger standard deduction permanent. Until recently, most retirement planning assumed that the 2017 tax cuts would expire at the end of 2025, and that would have meant higher tax rates across the board. For example, the 12% bracket would have jumped back to 15%, the 22% back to 25%, the 24% back to 28%, and so on. At the same time, the standard deduction would have decreased and the personal exemptions would have returned. According to the Tax Foundation, all of that combined would have resulted in tax increases for about 62% of Americans. So, this new law removes that uncertainty, and we now have permanently lower brackets and a higher standard deduction that will continue to be adjusted for inflation. Now, I want to hit the pause button on that point because it's easy to gloss over this, but knowing how the standard deduction works is critical to understanding your overall tax. So let's take a quick look at the tax formula and see how that works. You start with your total income, which includes everything you earned during the year. Then you subtract above-the-line deductions like contributions to an HSA or a traditional IRA. What's left is your adjusted gross income, or AGI. From there, you subtract either your itemized deduction or the standard deduction, whichever is greater. That leaves you with your taxable income. That's the amount that gets applied to the federal tax brackets to figure out how much tax you owe to the IRS. The standard deduction is essentially a tax-free zone. It's the amount of income the IRS lets you automatically exclude from taxation with no forms or itemizing required. This becomes especially important when we talk about the new senior deduction that's available through 2028. One thing that's been missed in a lot of the articles is that the standard deduction isn't just staying at its current level, it's actually being enhanced. I'm not even talking about the additional $6,000 senior bonus deduction yet. We'll get to that in a moment. Starting in 2025, the standard deduction is going to increase by $1,500 for joint filers and $750 for single filers. That's going to bring the standard deduction up to $31,500 for a married couple filing jointly and $15,750 for a single filer. Then, if you're over the age of 65, you can get an additional deduction on top of that. It's $1,600 per qualifying spouse if you're filing jointly. If you're filing single and over the age of 65, it's an additional $2,000. So in total, a married couple filing jointly with both spouses over the age of 65 will have a standard deduction of $34,700 in 2025. And a single filer over the age of 65 is going to have a standard deduction of $17,750. In real terms, that means that nearly $35,000 of income for a retired couple will be completely shielded from federal taxes before any other deductions or credits even come into the picture. So, if that couple has an AGI of $100,000, just a little over $65,000 would be considered taxable income. Again, this does not include the senior bonus deduction that's available through 2028, but I did want to make sure that we didn't overlook just how important these standard deduction changes are on their own. Now, let's talk about the brand new senior bonus deduction, which is completely separate from the standard deduction. Starting in 2025, the new deduction is $6,000 per qualifying individual who is over age 65. For a married couple where both spouses qualify, that's up to $12,000 in additional deductions. What makes this especially valuable is that it applies whether or not you itemize. If you do itemize, you can add this deduction on top of your itemized deductions. But for most people, those who take the standard deduction, this bonus stacks right on the top. So for 2025, the effective standard deduction for a married couple over the age of 65 will be $46,700. That's $31,500 for the standard deduction, $3,200 for the regular over age 65 increase, and $12,000 from the senior bonus deduction. But there are two really important things to know about how this senior bonus deduction works. First, it starts to phase out once your income gets over a certain level. That phase out starts at $75,000 for single filers and $150,000 for those who are married filing jointly. Once you cross that threshold, the deduction is reduced by 6 cents for every dollar above the limit. Second, and this is very important, this deduction is temporary. It only applies for tax years 2025 through 2028. So, we're looking at a 4-year planning window. This 4-year window isn't just something to note in your head. It's something that you need to plan around. For many retirees, it creates a rare opportunity to lower your lifetime tax bill by making smart moves while these deductions are available. If you're considering, for example, Roth conversions, the next 4 years could be your sweet spot. With the enhanced standard deduction and the senior bonus deduction, you can convert more to Roth while keeping your taxable income in a lower bracket. And in some cases, without triggering any federal taxes at all. Or maybe you've been holding on to appreciated investments in a taxable brokerage account. This window gives you a chance to harvest some gains and reset your cost basis, possibly while paying little or no tax, because now you have a standard deduction that's much higher. And if you're coordinating withdrawals from pre-tax accounts like IRAs, this could be an ideal time to smooth out your income, avoid those future tax spikes, and make your required minimum distributions more manageable down the road. There are really a lot of paths we could go down here with the planning opportunities this creates. But the bottom line is that you don't want to waste these next 4 years. Once 2028 ends, this window is going to close. So whether you're already retired or you're getting close, now is the time to take a fresh look at your tax strategy and put this window to work for you. Don't wait. Go talk to your advisor, run the numbers, and make sure your plan is designed to take full advantage of this opportunity while it lasts.